Well, firstly, let me say that this is not on my has not been on my bingo card. So the fact that we're seriously talking about Chair Powell being removed for cause one way or the other is certainly going to roil the Treasury market a bit. And I think that the initial move is going to be a twist steepening of the yield curve, meaning higher yields in the long end because of fears of inflation and continued fiscal largesse, and on the other side, the expectation that short-term interest rates will wind up going down because whoever replaces Jay Powell will wind up being more dovish and more of a in the President Trump's cult of personality in that way. But we have to remember it's not obvious that the actual Fed funds is going to be lowered very significantly because of a switch in the chair, because you still have more than half the members of the Federal Reserve thinking that they're only going to cut once or twice this year, or maybe not even at all. So the question is, how much power will that chair have? Because the chair is not a dictator in the Fed. It is a committee. There's 12 members who vote. So unless you get someone who is able to convince a majority of the other members of the Fed to cut rates aggressively, you're probably going to see more modest rate cuts rather than, a 200 basis point rate cut in a very short order.
Yeah, and that leads to my question. I mean, could this all change if the Fed decides to drop rates?
Yeah, well, I think a 25 basis point cut, probably wouldn't necessarily placate the president. I mean, obviously, he thinks that interest rates should be much, much lower. I mean, you look at the economy, I'm not convinced that that's true, right? Like, I think that there are political reasons why the president wants it lowered. But from an economic standpoint, interest rates actually look pretty appropriate to me. I have my model has the neutral Fed funds rate at around 4%, maybe 3.75 to 4%. So, 25 or 50 basis points of rate cuts would get us right there. So we're very close to neutral, as far as I'm concerned. And cutting all the way down to say 3% or 2% would risk the potential for faster growth and therefore higher inflation overall, which is one of the things that the market's pricing for, and that's why once the recent headlines hit the Bloomberg terminal on the president's possible action, you've seen the market move, and that's just going to get bigger. So you saw 30-year yields sell off a few basis points. You saw 2-year yields rally a few basis points, so go lower. So you wind up with this twist steepening of the yield curve, and that's not necessarily going to be great for the economy, quite frankly. So even if you have lower interest rates in the short end, long end interest rates are telling you they don't like this, and the market doesn't like this very much.
Yep, and that's kind of what we're seeing there. So we have the 30-year, which we were looking at this morning, touching 5%. We're up at 5.06% of 4 basis points, and that's just in the last few minutes. So just what Ira was talking about, higher rates on the long end. Short end on the 2-year, it's come in 6 basis points. We're now at 3.88% on the 2-year. Ira, at the FOMC, the folks who vote on these rate things, is that public how each person voted, or is that private?
Yeah, so we do know how everyone votes. Typically, there's a consensus that's built, and then you have one, two, occasionally, very occasionally, three people do what we call dissent, but
Okay.
basically vote no. It doesn't happen that frequently, but it does happen on occasion. So there's the possibility that you can wind up with more dissents among members of the FOMC, basically people voting against a policy, certain policy actions. Now, something that you haven't seen, at least not in my lifetime, and from what I can remember going back to reading these minutes back to the 1970s, I don't recall a Fed chair ever dissenting. I'm not saying it's never happened, but but typically the chair will vote with the majority, right? And but you have had periods of time when you've had 2 or 3 members who've said, hey, we shouldn't be taking this policy action. And the way that we typically view that is like, okay, if 2 or 3 people say no, then it's probably a lot more members. So it's more like not quite half, but close to half. But they don't like to show that there's that much well, not animosity, but discord within the committee. But there are people who say, okay, look, if we're going to vote, I'm going to vote no. You vote yes because it's going to pass anyway. So why show that we have a lot of discontent with this particular policy action within the committee?
So, Ira, there was some word that Kevin Hassett could be the early frontrunner to take over Fed chair, but some say his closeness, proximity to the president, that could raise some questions about Fed independence. So, what kind of impact would that have?
Yeah, well, that's one reason why I would be very worried about the long end of the yield curve because we know that independent central banks tend to produce longer term better outcomes than those that are have a very strong political bent, and that's I think in part because politicians, generally speaking, want lower interest rates, always want lower interest rates. In fact, Chairman Greenspan was very famous in saying, and he obviously spanned over multiple presidents, said he's never been asked by any politician to raise interest rates. It was always about cutting interest rates. So I do think that you do risk having steeper yield curves, generally speaking, and probably somewhat higher yields, particularly 5, 10, and 30-year bond yields are likely to be somewhat higher, and that will increase the borrowing costs for a large portion of the economy. Because if you think about that 5-year sector, for example, that's where a lot of people get auto loans and other shorter term financing, and obviously the 10-year tends to be the most important for things like mortgages. So you can wind up with the housing market maybe being affected if 10-year yields were to go up toward 5% again, and you wind up with 8% mortgage rates, right? That will certainly affect that'll permeate throughout the entire economy. So having an independent central bank, I think, is very important, and clearly President Trump is wants to have more influence on the central bank. At least that's what such policy action like removing the Fed chair would certainly show that, hey, I want the Federal Reserve to be use my policies, not necessarily an independent policy from what the White House is looking for.
Ira, in talking to your institutional investor clients, is there some replacement that maybe the market would like, or some replacement maybe they don't like? Have we gotten to that point yet?
Well, it does depend on who it is. I think someone like a Chris Waller, who's currently a governor. Chris Waller is he's currently a Fed governor. He would be the kind of he's a bit on the dovish tilt within the Fed, so he would be an interesting person. But he also has deep institutional knowledge, right? He's been on the Fed. The Federal Open Market Committee for quite a while, so I think that he would be someone who, wouldn't. He would be relatively benign for the markets. Someone like a Kevin Warsh, who was a Fed governor, over a decade ago. Again, institutional knowledge. He might be a little bit more dovish as well, but also someone who I think has some respect among the investment community, and has a deep track record in working at the Fed. And I think anyone who in that ilk who has been a member of the Federal Open Market Committee or is a well-respected monetary economist, I think would give the market at least a little bit of comfort. But you're still going to see, if Jay Powell is removed, you still will see a pretty big steepening
Yep.
of the yield curve, I think, and higher yields in the long end.